Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday Market Update, 9 a.m. Eastern. Every Monday morning, get you ready for the week. Stocks to watch, economic news you need to know, and we reached new all-time highs this week, and investors are already getting worried about this bull market. Even one of the biggest bulls on Wall Street, Ed Yardeni, is raising the alarm that the market is due for a pullback. Now, against this pessimism, the same strong economic fundamentals and monetary policy that pushed stocks up initially are still in play. I'm going to detail the history behind bull markets, how high this one could go, including a 10% plus gain, and which stocks you need to be watching. Stick around after that. We'll do our Monday market update, all the stocks to watch this week, and the economic trends you need to see. But first, if you've ever wondered what's in my portfolio or what stocks I'm buying, you can now by joining me on the Blossom Social Investing app. It's like Twitter, but for investors and without all the drama. The app was created by YouTuber Brandon Beavis for investors by investors. I just started using it last year and love the app for getting ideas and sharing my portfolio. And I know, not another social media app, but this one is much more than that. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 90,000 investors in this social feed to see what everyone is talking about. I've shared my portfolio on the app. It's totally free to download, so look for the link I'm going to leave in the description below. Back to our main topic though, because Wall Street analysts were caught flat wrong last year when the S&P 500 jumped 23%, well beyond anyone's targets. The market is already up more than 2% in January, even despite a little more volatility. And to understand why, and if the market can continue higher, you only have to look at that bigger picture. Hopes for lower interest rates this year after the Fed embarked on its fastest rate increase in over 40 years has investors betting on higher corporate profits and consumer spending. Now, usually when the Fed is expected to cut rates, it's because the economy is tumbling into a recession, but this time the economy is doing really well. GDP, or economic growth, for the last 3 months of 2023 came in strong last week at a 3% pace, with unemployment still around its record low. And consumers are still spending, even as debt and credit card defaults edge up slightly. Looking at those lower interest rates, we see here the CME FedWatch tool. It's a market-based expectation of Fed rate decisions. So the futures pricing for interest rates put in here as odds of what the Fed is going to do at its meetings. We can see down here at this meeting here this week, 31st of January, almost unanimous that the Fed is going to be on hold, going to keep rates at 5.25% to 5.5% there. But if we go out to March, we can see that now March is pretty much a 50-50 bet. 50-50 chance that the Fed will cut in its March meeting. That is lower from over about a month ago, a week ago. It was 46% for a rate cut. A month ago, it was 72% in favor of a rate cut on those market-based odds. Now, that has come down a little bit as just a stronger economic growth and a little bit more resilient inflation than we expected. But if we click out here to the May meeting, those market-based expectations are still almost 90% chance that the Fed does start cutting its interest rates by that May meeting. We can go further out here to probabilities. We see here almost that 90% odds that the Fed does start cutting in its May meetings, and then in each subsequent meeting through the year, almost 6 rate cuts through this year. And this is all supported by inflation that, while still higher than the Fed's 2% target, is coming down. The personal consumption expenditures PCE report measure came down to sub 3% pace last month. That's the slowest pace of inflation since mid-2021. And so remember, those lower interest rates are supportive of stocks because it means a lower cost of borrowing for corporations and consumers and a reversal of that 2022 bear market pain. Last year started the bull market had analysts scrambling to upgrade their 2024 forecasts. In a survey of the 13 biggest banks, analysts predicted the S&P 500 will close this year somewhere between 4,200, which is JP Morgan's estimate at the bottom here, and 5,400, which is Tom Lee's Fundstrat. Now, these forecasts, most of them were made in December and are already a little old. I expect a lot of these to be updated higher over the next few months as the market runs past these, but analysts and investors are already worrying that this bull market is getting beyond itself. The median forecast here of 5,000 on the S&P 500, that's for the end of the year and is only really about 3% from where the market closed last week. So to help answer this question, or at least give you some confidence that stocks can keep going higher, we're going to look at valuations and what stocks have done in previous bull markets. We see here in a chart of bull and bear markets all the way back to 1926 that bull markets have averaged more than 6 years from that low point in stocks, while bear markets have lasted just 16 months from the peak. We reached the prior peak in stocks on that S&P 500 index on January 2021. That's when stocks reached their post-pandemic peak and then hit the low in October 2022. So that would be a bear market of 21 months. That means the current bull market is only 15 months long. Hardly an old market. We also see that bear markets have seen stocks fall by an average 38% from that high, from that peak in stocks, with the recent bear pushing stocks lower by just 26% to the worst of it. Bull markets on average have seen the stock market surge 339% from its trough, with this bull just 37% higher. So again, hardly indicative of a market that has run beyond those historical precedents. Now, of course, the market's worry for stocks is nothing new, especially after a new bull market has begun. We see in data by LSEG that stocks have averaged 16% return in the 3 months leading up to a bull market, but then typically get skittish. 1 month after the new high, stocks have been up just 0.2% as investors worry that that bear market is coming back. 3 months after the new high, the market is only a slightly better place, up 2% on average, though it is more frequently up than down. Now, you also hear a lot of investors worried that the stock market has gotten too expensive, especially tech stocks that have really jumped higher. I used earnings data from Robert Shiller's dataset. That's nominal numbers, not his CAPE adjusted stuff, and the S&P 500 levels at the peak in each of the last 6 bull markets. So the highest point in stocks in each of those 6 bull markets to find the peak price to earnings valuation, that peak PE ratio, and then compare them to the current ratio. Those PE ratios, the price to earnings ratios, have averaged 23.1 at their peak in prior bull markets. Now that's only about 3% higher from the current market's PE of 22.4 times that trailing earnings on the index, and I'll admit that that doesn't leave much room for optimism, but the 3 bull markets with higher PEs, these higher PE ratios, suggest stocks can keep going. Now, a lot of analysts, including Ed Yardeni, have been making the comparison between the surge in tech stocks recently with the dot-com boom of the late 90s. In fact, Yardeni recently told CNBC that we are wondering whether a bout of irrational exuberance might push this multiple higher, inflating a speculative bubble in the stock market as occurred during the late 90s. And looking back to that dot-com bubble, besides a 1-month mini crash in 1998, the 90s bull market climbed unstoppable for 10 years to March 2000 and saw S&P 500 stocks up 350%, with the Nasdaq up more than 1,200% over the decade. Stocks then reached their peak valuation at 29.8 times trailing earnings in the market, which would imply another 33% upside if stocks were able to reach that point again. But nation, understand the missing piece in all of this is whether you believe that stocks can reach that previous market PE ratio or not, is that part of this formula is always changing. And sure, stocks look fairly valued now, around 22 times corporate profits over the last 12 months. But if we look at estimates for this year's earnings, the picture starts looking better. Companies in the S&P 500 likely closed out 2023 with profits of $217 a share on aggregate. So that's all the companies in the S&P 500. That's where we get that PE ratio, with the price around $48.76 on the market divided by those earnings for that PE ratio. Analysts expect those companies then to grow earnings by almost 12% this year to $243 a share. And while I think that might be overly optimistic, even a 10% growth to just $239 per share on the S&P 500, we see how the market can continue to run higher. At $239 per share in S&P corporate earnings, the market would rise to $53.53 and still be at that same 22.4 times PE ratio. And that 5,400 target by Fundstrat is looking within reach. Then another 10 or 12% earnings growth in 2025 takes earnings to $265 a share on the S&P 500 and the index almost to 6,000, all without getting more expensive. Now, this history lesson doesn't mean that stocks cannot fall or that they will definitely rise, only that the precedent and the momentum are on investor sides. Stock prices increase more often than they decrease over time. And right now, we also have the benefit of that good environment for solid economic growth and the prospect of lower interest rates. Stocks aren't cheap at all, but they're not expensive either, and those rising earnings should make for a good bet over the next few years. Revisiting analysts' upside targets by sector, so which sectors analysts see the highest returns over the next year, we do see that energy is forecasted up 25%, consumer discretionary up 13%, and materials up 12% for the 3 best sectors according to those analyst targets. As the favorites, while healthcare 8.3%, industrials just 7.5%, and technology only expected to increase another 6.2% on a sector-wide basis, are expected to post the lowest returns over the next year. Now, I do like energy stocks such as Devon Energy, ticker DVN, as well as Diamondback Energy, FANG, and Chevron for their cash flows, though these aren't the kind of stocks that are going to make you rich. These are good dividend names with rising earnings and rising cash flows, but not going to make you rich like some of the tech stocks have over the past year. Stocks in the consumer staples like Dollar General, ticker DG, and Walgreens Boots Alliance, WBA, are primed for a rebound, could be good investments on that turnaround. In fact, WBA is already up 10% since highlighting it in October. They are announcing a lot of sales of part segments of their business. I think this whole company could be for sale pretty soon. I love the pullback in SoFi Technologies, ticker SOFI, as a way to buy more shares, and I think we've reached peak fear in shares of Alibaba, ticker BABA, and a lot of those other Chinese stocks. and going to make it a strong investment over the next few years. I want to turn it over to some of the stocks I'm watching this week, a little bit different for this week because we've got the Magnificent Seven, many of them reporting their earnings this week. So it's going to be a very big week for tech earnings. Magnificent Seven, probably now more like the Sexy Six after Tesla has fallen 35% from its peak. We can see here the stocks over the last year, those 7 stocks: Apple, Tesla, Amazon, Google, Microsoft, Meta Platforms, and Nvidia, all doing relatively well, except Tesla there over the last year. 5 of the remaining big tech companies, again, Alphabet, Microsoft, Amazon, Apple, and Meta Platforms, the old Facebook, all going to be reporting their earnings for this week. It seems that big surprises and big stock reactions have become the norm for this earnings season. We've seen a lot of those stocks, including Tesla, selling off 12% just in its earnings week. So that might make option strategies a helpful tool to make more money or reduce risks. So if you think a big move is possible in one of these stocks, then a strap strategy will make money whether the move is higher or lower. So if you do think that the volatility is going to increase in some of these, it's going to be a big pop one way or the other, but you're not sure which direction. This is where you're going to buy 2 call options with strikes that are close to the current price while also buying a put option at the same stock price. I'm going to use Amazon only as an example here to demonstrate these strategies. This doesn't mean I think Amazon is going to jump higher or crush lower on its earnings, but I want to use this to demonstrate these option strategies just in case you think there is going to be some real big volatility in some of these stocks. You know what option strategies to use for that. We can go here to options, and you can see that it has February 9th options available. That would be the end of this week. That would encapsulate those earnings, but I'm going to use the February 16th options instead here. We can see that with Amazon at almost $160 a share, we can scroll down here. These are the call options. And we can buy 2 call options for February 16th expiration at $160 strike for right around $5.90 each. So we'd pay $5.90 for each of those 2 call options. And if we scroll down to the put options down to 160, remember we're doing the same strike price. So the 160 strike price on each of these, we can say we can buy 1 put option for about $6.40 each. You can see here in the payoff table, the position makes money if shares fall 11% to $141, or if they rise that 11% to $176 or above on earnings. Now this strap strategy, it is a little bit more bullish. It is going to make you money if the stock does fall off a cliff, but it'll make more money as the stock runs higher because you've got those 2 call options. So that right to buy those 200 shares, that's every call option is worth 100 shares. The right to buy 200 shares at the $160 strike price, or the right to sell 100 shares at the $160 strike price. So as you see the stock move further away from that strike price, one of those 2 sides of your bet is going to be more profitable. Here you also see the most an investor can lose is that $18 per share that you paid to buy those 3 options, the 2 call options and that 1 put option. This is a very high risk trade, but a good tool if you expect the shares to be more volatile than the market expects. Now, on the other hand, for investors worried that one of their stocks might fall on earnings, the collar strategy is going to help keep some of that upside while limiting the downside risk. This is where for every 100 shares you own, you sell 1 call option. So that's kind of like a covered call strategy, but you're going to sell 1 call option with a strike price above the current price, and then use that money to buy a put option below the current price to protect your stock. Using Amazon here again, we are in the options contracts for Amazon. The February 16th expiration for these, and we scroll down, we can sell the $167.50 strike price at $3.10 each. So what this means is we are limiting our upside potential in Amazon to that $167.50 strike price, that per share price. We're selling another investor the right to buy those shares from us for that stock price, for $167.50. But we're collecting that $3.10 a share right now. Immediate cash flow on that. We do cap our upside potential in the stock for over the next 2 weeks, but we do collect that money, that $3.10, and we can use that to buy that put option protection. If we scroll down here, we can use that $3.10 to buy these $152.50 strike price puts for $3.15. So it's going to cost you just 5 cents to completely protect yourself in these shares of Amazon. So again, with the cost of buying that put almost totally covered by selling the call, it's almost a no-cost position, and you still benefit if Amazon rises to $167.50 on its earnings, about 5% higher. So Amazon can keep going 5%. You're going to keep making money on that over the week. If earnings are surprisingly bad, though, if the losses on your shares are limited to this point at $152.50, that is the put option that you bought. That is going to protect your downside past that point. If so, this is about 4% lower from where the stock is now. So if Amazon falls more than 4% lower on bad earnings, you're protected at that point. You will lose no more than 4%. No matter how far Amazon falls, that loss from the current $159 to $152.50 is the worst it's going to get for you. I'm also watching Equity Residential, ticker EQR, this week. It's going to be reporting its earnings on Tuesday, and it's going to be a very important look into the health of residential real estate stocks. A giant wave of apartment projects were completed towards the end of last year, and that supply is expected to grow this year. So investors are notably worried that that means rents come down for these apartment stocks, and it's part of the reason EQR is down 33% since 2022. On that, though, we do see that in these NAREIT data that on apartment stocks, that funds from operations, that FFO measure for the group, are only expected to rise 3.7% this year, with EQR underperforming the group at 2.5% growth. That means we could still see a tough 2024 for these REITs, for these real estate investment stocks, but valuations are starting to look attractive, especially EQR at 16 times FFO. And investors are earning that 4.5% dividend while they wait. Showing you that big picture idea here with the sectorspiders.com sector tracker, we can see that 8 of the 11 stock sectors closed higher last week, with energy really bouncing back on that spike in crude oil. Last week's strength in oil might not be durable, though, as some of it was built on just temporary shut-ins for the production from that cold. So that cold snap that came through the United States shut in a lot of the production in key areas. We did see prices spike to $78 a barrel on oil. Now, while I am overall bullish on oil this year, oil production is slightly outrunning demand, and I would wait for oil to fall back to around $73 a barrel before really adding any more to the stocks into this sector. And one of the things I wanted to point out here is stocks in the consumer discretionary sector actually did better than it appears. We can see that it was the worst performing sector last week, down 1.8%, but 29 of the 53 stocks, so more than half of the stocks, actually did close higher. If we switch to index weights here, see the biggest weights in this consumer discretionary sector, we can see that it was only the fact that Tesla, which is 13.7% of the sector, fell more than 13% and dragged the group lower. Without Tesla, then the group would have closed up 0.3% for the week. So even as employment cools down, consumers use more credit cards, and household budgets aren't really stretched here. And I think consumer spending looks good and will hold up this year, propelling these consumer discretionary stocks higher. Join me on the Blossom Social Investing app and see all the stocks in my portfolio with the link in the description below. Or click on the video to the right for the best stocks to buy in 2024 and some outrageous predictions. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.